This is a bookable summary of the book Rule Number 1 by Phil Town. Are you intimidated by the stock market? Do you believe it's a complex and risky game meant only for experts? Well, it's time to shatter that misconception. In this video, we'll reveal the one rule that can empower anyone to beat the stock market and achieve financial success. Inspired by Warren Buffett's philosophy, Phil Town presents Rule Number 1. Discover a remarkable business, determine its true value, purchase its stock for half that value, and repeat the process until you've amassed wealth. Get ready to learn the key indicators that will lead you to those extraordinary businesses capable of transforming your life. Prepare for a paradigm shift in your understanding of stock market investing. Unleash your inner investor, beating the market made simple. Who says you need to be a financial expert to be a successful investor? The truth is, you don't. Contrary to popular belief, managing your money doesn't require specialized knowledge or a team of experts. In fact, all you need are a few savvy tactics. Thanks to the internet, the tools and knowledge you need to make informed investment decisions are readily available and affordable. Websites like MSN Money, Yahoo Finance, and CNN Money offer comprehensive data on thousands of stocks, while platforms like rule1investing.com provide useful investment calculators. Gone are the days when experts held all the power. With technology on your side, you can access tools that are more accurate than ever before. And don't let anyone tell you that beating the market is impossible. Despite what the efficient market theory claims, historical events like the 90s bubble and the success of Warren Buffett prove otherwise. So forget the myths. Embrace the internet and these strategies to become a successful investor on your own terms. Rethinking the diversify and hold myth. You've probably heard the phrase diversify and hold countless times as the go-to strategy for investing in the stock market. But here's the truth. It's not as safe as it's made out to be. If we look back at the last century, a long-term, diversified portfolio would have had a zero rate of return for significant periods. That's 60 out of 100 years. Clearly, diversification alone doesn't guarantee safety. Instead, consider focusing on monitoring all your stocks for improved security. When your portfolio is diversified, it becomes challenging to keep track of every stock's performance. Furthermore, understanding the dynamics of various industries becomes difficult. Imagine you're a pharmacist and receive a red-hand letter about a drug's unexpected side effects. If you have knowledge of pharmaceutical companies, you can quickly react and sell your shares to avoid losses. However, lacking industry understanding can leave you unaware until it's too late. In reality, diversification doesn't shield you from market fluctuations. When a significant amount of money is withdrawn, mutual funds decline, prompting further investor withdrawals and faster value drops. This scenario may occur when baby boomers withdraw their retirement investments. Invest wisely. Treat stocks as if you're buying the company. When it comes to investing, it's crucial to approach stocks with the same mindset you would have if you were buying the actual business. Smart investors understand this and only invest in companies they'd be happy to own in the long run. Why? Because thinking of stocks as ownership in the company helps you make careful investment choices. Sometimes the ease of selling stocks quickly can lead us to unnecessary risks. We might get tempted by a risky business or get swayed by a single promising growth rate in an average company. But if you were considering buying the entire company, you would naturally exercise more caution. You'd thoroughly evaluate its performance, history, and management, enabling you to make wiser investment decisions. To further improve your investment choices, it's wise to invest in sectors that align with your interests and expertise. If you work in IT, for instance, investing in that field would give you an advantage. You already possess knowledge about different providers, their strategies, and product quality. Remember, investing in a business is like voting for its continuation. Your investment speaks volumes about where you choose to allocate your resources. As a rule number 1 investor, you wouldn't support a company that profits by exploiting children in Bangladesh when saving for your child's education. Be aware that your investment choices have an impact and reflect your values. If you're finding this video to be enjoyable, show your support by liking it and subscribing to my channel for even more fantastic content. Your encouragement means everything to me and drives me to keep creating videos for you. Unveiling the moats, unlocking a company's competitive edge. Ever wonder how some companies manage to stay ahead of the game, unaffected by competition or inflation? It's all about their moats, assets that shield them like castle walls. Investing in such companies can be a wise move. So, what exactly do moats do? They give a company the power to dominate a market, adjust prices with inflation, and generate substantial profits for growth. Moats come in various forms. Some are intangible advantages, like partners or trade secrets, making competition nearly impossible. Take Pfizer's Viagra patent, for instance. It prevented rivals from copying the product, leaving Pfizer uncontested in the sexual enhancer market. Strong brands can also act as moats. Coca-Cola, for example, boasts a loyal customer base that consistently chooses its products over competitors. Moats can also manifest as affordability and convenience. Walmart's massive size allows it to negotiate favorable deals with suppliers, offering customers competitive prices. Switching costs can create moats too. Despite disdain for Microsoft, many still use Windows because it's intricately tied to exclusive software, making switching operating systems a daunting task. Lastly, legal privileges can grant companies monopoly control over a market. PG&E, for instance, has exclusive rights to provide power in its area. Understanding these moats can help investors spot resilient and prosperous companies capable of standing their ground. Unveiling the secrets of a company's competitive advantage. Spotting a company's competitive advantage may not always be a straightforward task, but there are 3 simple calculations that can help us identify if a company has a moat. Let's explore these methods. Firstly, consider the earnings per share (EPS) growth rate. If a company consistently achieves a 10% increase in EPS over a period of 10 years, it indicates a strong competitive advantage. For instance, if a restaurant's EPS rises from $20,000 to $160,000 in a decade, the EPS growth rate is calculated by dividing 72, rule of 72, by the average number of years it takes for the figure to double, which in this case is 3. Thus, the restaurant's moat is 24%. Secondly, a consistent sales growth rate exceeding 10% is another sign of a wide moat. For example, if a company like Garmin doubles its sales 3 times over 9 years, resulting in a 24% sales growth rate, it signifies a strong competitive advantage. Lastly, a free cash flow growth rate consistently over 10% indicates profitable operations. For instance, if Garmin's free cash flow doubles just under twice in 7 years, resulting in an 18% growth rate, it demonstrates their high profitability. The CEO factor, investing in driven and owner-oriented leaders. When it comes to choosing the right company to invest in, it's essential to consider more than just the big 5 criteria. One crucial factor to evaluate is the effectiveness of the CEO you're entrusting your money to. Opt for a CEO who is owner-oriented. They make wise long-term decisions and keep shareholders well-informed. A good owner-oriented CEO doesn't shy away from sharing problems and providing reasonable explanations. They avoid short-term actions that may boost stock prices but harm the company in the long term. Imagine an executive who prioritizes increasing stock prices for personal gain without caring about the future of the business or your shares. Avoid such scenarios. Look for a driven CEO who puts in the effort to keep the company profitable. These leaders set ambitious goals and inspire employees to achieve them. With such a CEO at the helm, the company is poised to generate increasing value, which is beneficial for your investment. Take Darwin Smith's example, who transformed Kimberly-Clark from a mediocre company into the world's top paper-based consumer products company. Smith's 20 years of dedication and vision paid off, creating immense value for shareholders. Assessing a CEO's drive and integrity enables you to make an informed estimation of a company's value, demanding a margin of safety for profitable returns. You know that theory that claims the market always reflects the stock's true value? Well, turns out it's wrong. Price and value are not the same thing. The trick is to seize the advantage when the difference between them is in your favor. Price is what you pay for a stock, while value is determined by the money a business generates over time. Assessing a stock's value can be tricky, but there are tools like sticker price calculators available online. Remember, markets can be off the mark in the short term. Savvy investors took advantage of dropping metal prices in the late 90s, knowing their real value would rebound. They made a fortune when demand soared again in the early 2000s. To invest wisely, demand a big margin of safety. This means the value minus the price should be your guide. A good margin of safety is half the investment's value. When Dell's value was estimated at $40 a share in 2000, a fair price without a margin of safety would be $20 per share. However, when the price dropped to $20 a share in just a year, the margin of safety reached 50%. That would have been the perfect time to buy. Remember, a good margin of safety not only ensures great returns, but also shields you from potential market bubbles. In 2000, all NASDAQ stocks that crashed had prices higher than their values, so don't overlook the power of a margin of safety. We hope this video provided valuable insights and information for you. What sets apart the price and value in stock investing? Are they the same thing? Or is price what you pay while value is determined by a business earning over time? Let us know in the comments. And if you learned something new in this video, make sure to hit the button to subscribe for more videos. Thank you, and until next time.